Stocks are heading lower today as an unexpected drop in new home sales raises red flags again. Tom Lee, chief U.S. equity strategist over at JPMorgan Chase, says he still finds equities attractive. He joins us now from his firm in New York with more. So, Tom, we've got stocks trading down for, looks like now, 4 days in a row here. Again, worries about the economy. How much do these weak economic data points worry you?
Well, you know, we're inevitably going to get setbacks because we're still at the stage in this expansion, and we view this as an expansion, a sustained expansion, where, you know, some data points are not going to be decisive one way or another. So, you know, you're going to cause plenty of controversy about whether there's a recovery. But, you know, if the question is, do we start having doubts about our forecast because of the new home sales number? Absolutely not. We still believe there's an expansion that's going to be very strong in 2010. And I think it really points to a period of rising asset prices for equities.
Tom, what gives you that confidence?
Well, you know, for instance, you know, when we look at new home sales and the factors behind it, you know, I think the credits, the tax credits did play a partial role. But what's really helping stimulate new home sales, and I think it should continue, is really the record affordability. You know, we've got low interest rates, and we've got home prices down significantly in a lot of cities from their highs, and that's really what's motivating a purchaser to buy a house.
What if you see, though, the federal credit for first-time home buyers taken away? What if you see mortgage rates starting to go up? I mean, aren't you concerned that you could see mortgage rates maybe climb north of 6% next year?
Well, I think that, you know, our view still is that rates, there's very little likelihood of rates increasing. Part of it has to do with the fact that the Fed is such a large holder of mortgages that any attempt to raise rates, even on the short end, is likely to trigger losses in their QE portfolio. So, you know, our assumption is that mortgage rates stay low. And then with regard to the tax credits expiring, I think it's been very, very helpful in clearing inventory. And as you know, it's really the excess inventory that causes pressure on home prices. So we really do need to buy some time to really just clear out this excess home inventory. All
right, but Tom, what do you make of, I mean, we hit, a high of 1097 on the S&P on October 19th. We kind of keep bumping up against it. Why is that? We kind of can't pierce through that.
That's right. I mean, it's, well, you know, it's an invisible ceiling. I think 1100 is because, one, we've made a big move from March, and it's too early for people to talk about 2010, you know, in terms of hanging their hat on the numbers. And while third quarter has been very good, especially from a top-line perspective, I think the debate right now is how much of this is FX versus volumes helping top line. And, you know, we probably won't really know until fourth quarter how much of this is a volumes-based improvement in top line versus sort of FX causing one-time benefits.